Welcome everyone. This is our first Coffeehouse web chat, right? This is a total trial run. This idea was just born out of my head just a couple of weeks ago, and I basically just thought, okay, you know what? So many people have been asking, right from the get-go, oh, a monthly meetup is great, but we want to
join the meeting.
We want to chat more. We want to engage more. We want to network more. We want to socialize more. We want to learn from each other more. We want to learn from everyone's experiences, and other people want to share their experiences. So, and the meetup is a great forum for delivering some content, some education, but I wanted to use a different format to just sort of engage. So it wouldn't be just once a month. This would kind of interstitially give people a chance to network and engage without having to wait another month. This is going to be an open format, open forum, some free-flowing conversation. It's going to be an opportunity to ask questions for other people, to share answers if they have answers to people's questions. Right now, I don't have a set format. I don't have an agenda. I don't have a presentation. So this is really going to be all about you guys.
Connecting.
Sorry?
I think he said it's not connecting.
It's not connecting? Who said that? Maureen? Yeah, I apologize. I'm not going to be able to fix everyone's technical issues. I said that kind of right off the bat. I literally just signed up for a Zoom account like last week. So I don't know how it really works. It's working for me. It's working for most people. So that's the best I can do right now. Okay? So anyway, coming back to it, there were a few questions that people posted on the Meetup forum. Weren't a lot. There's a couple. So I kind of just wanted to structure this like a AMA right now, right? Ask me anything, and you don't even have to ask me. I know there's lots of people on this forum who have experience, investing inside Toronto versus outside Toronto. They have experience in renos. They have experience in evictions, or so. Like basically, what's on your mind right now? What's been troubling you? What's been holding you back? So that's basically, just wanted to open it up. So, you can just make sure, if you want to speak, just make sure that you unmute yourself. Otherwise, no one's going to be able to hear you. Just make sure, yeah. So I don't hear a lot of background noise, which is great. So everyone doesn't have to keep muted. Mute yourself if you're in a noisy environment, but unmute yourself otherwise. So that's cool. Click on gallery view. Gallery view is going to allow you to see everyone rather than just looking at me, which makes me kind of uncomfortable. Speaker view, whoever is speaking, I think Zoom switches to the active speaker. So you could do that if you want. I prefer gallery view.
Okay. You should point out that gallery view is the multi boxes up in the top right.
Okay, thanks, Jason. Gallery view is the multiple boxes up in the top right of your screen. Right now, it might say speaker view. If you click it, you could probably switch to gallery view, something like that. Okay, and then just like a regular meetup, you can raise your hand. You can answer yes or no. You can give me a thumbs up, thumbs down. You can clap. This is all in this area here. I don't really know how it works exactly, but I think if you click on, I don't know, participants or something like that, it gives you all these options. So if I ask a question, for example, you can raise your hand, you can answer, you can respond. I also invite you to put your questions into the chat, and then we're going to go through the chat and try to answer those questions. So, I mean, that's basically it. There's no real set format. So I'm just going to open it up. What's on your guys' mind? Seattle, I'm listening.
You're talking to a bunch of Canadians. Nobody's going to jump in first.
Come on, what's going on? All right, I'm gonna.
Do we want to talk about, I'm just going to throw something out there. Do we want to talk about Airbnb? I don't know if anybody's got any experience with Airbnb. One of my current concerns is doing Airbnb this coming year, and the tax implications of, there's this rumor going around that CRA is going to turn your property into it's going to designate it as a commercial property. So you're going to pay tax, but on top of that, when you go to sell it, you're going to pay tax on your property of, I suppose, 13%, which is terrifying.
Yeah.
It's like I would have to make 3 times, 4 times the nightly sum to make it worthwhile from a profit and effort standpoint.
So they would actually designate, what that sounds like is they're trying to turn it into a commercial property. So
Yeah.
as you might know, on residential resale properties, HST is not it's not applicable, right? However, and I know a lot of us here, we have experience on residential, we don't have experience on commercial. In commercial, upon the sale of a commercial property, you actually pay HST, or sorry, on the purchase of a commercial property. So they're probably trying to, well, the CRA is trying to designate these properties as commercial now. So yeah, I mean, that's a big implication, notwithstanding the fact that around, I don't know, June, July, I'm not an expert on what's going on with the Airbnb rules, but I've got a couple people on my team who've been following it. But I know June, July, they're looking at actually changing, or at least the city's, I think, ruling on something. You know more about this, right, Jason?
Yeah, my understanding is, yeah, they all sat down last, I want to say September. And then the city realized that they needed more than 2 hours to discuss this, and everybody involved said they couldn't actually coordinate the schedules until this coming September, where they're going to talk about it. I have heard that the decision's probably going to happen before this September. They're going to have a meeting something like in August, and the thinking is that even if they do say these are the new rules, it will be, let's say September 1st, they have that meeting, it will have a 3-month period while they allow people to discuss and think about it, and then it gets implemented or possibly gets pushed back again.
So basically,
but that's the city versus
right.
the CRA. The CRA right. is what scares me.
Right. So you have the potential of this double whammy right now.
Yeah. And I don't know if if the CRA comes out and says in whatever time, as of 2 months from now, we're going to start turning your property into a commercial property if you run Airbnb as of August 1st. Okay, I'll make a decision to do it. But my bigger worry is they're going to go, oh, we're going to do this, and we see that you've been running at Airbnb for the last 6 months, so we're also going to go back. I don't know. My understanding is Airbnb or CRA doesn't necessarily do that with tax stuff because it is terrifying to people to change your tax landscape going retroactive. But
well, I mean, that would be ridiculous for them to go retroactively back to the acquisition date of the property. Like that would be, I feel like at that point, you'd need a tax specialist and you'd be basically fighting with the CRA. But, upon the kind of change of use into, let's say, long-term rental stock into Airbnb, okay, that's if they wanted to make that argument, then sure. Good question. I would actually say, I mean, first of all, we have a tax specialist who's coming in next month, so that will help. Oh, sorry, not even next month. He's coming in March 20th, so 2 weeks. So our next meetup, we actually have an accountant who's a real estate investment focused accountant. His name's Peter Catini, and Peter is the partner of George Doobie, who we've talked about at the meetup a lot. And George Doobie literally wrote the book on real estate investing and tax and accounting. It's a really, really boring ass book, but there's lots of, yeah, don't tell him I said that. But George had some personal health stuff going on with his family, so he couldn't make it, but his partner Peter will be coming in. This is going to be a really good question to ask him.
I bounced it off of not that question, but I bounced some questions around like saying Airbnb and things being up in the air, and at REI like 9 months ago.
Mm-hmm.
And George couldn't give me a straight answer. He said it's all sort of up in the air, and he sided on the side of caution. Like I can't remember his exact words, but it was pretty much, if I were you, I wouldn't do Airbnb. But he's also an accountant, so accountants are always don't do anything. It's scary.
Did you ask him in a forum, like in front of everyone, or did you ask him privately?
In private, yeah.
One thing I've also noticed is when you ask, if you ask him kind of like in front of 200 people, he'll give you a generic answer. But then if you speak to him privately and he understands your situation, then he might go a bit deeper and give you a more specific answer that's more tailored to you. Cool. Does anyone else? I don't know. I wish I had more expertise in this. It's a very advanced and detailed question. I don't have a great answer. Does anyone else have any input on this though? Someone called SK said that she knew that hearing was also pushed or in August or September. So I don't know. Whoever SK is, are they interested in chiming in? She's on mute, whoever that is. Okay, does anyone else have any questions or comments on the whole Airbnb and CRA? So I know that some people are looking at Airbnb as a strategy. So let's deviate from this whole CRA aspects a little bit. But if we talk about Airbnb and short-term rentals as a strategy, an investment strategy, notwithstanding the tax aspects of it. So it is something that we're actually looking at, not necessarily Airbnb and short-term rental. That might be a short-term stopgap because there's a lot of uncertainty. We don't know what's going to happen around that. We're going to be allowed to do something until a certain point in time. However, it doesn't mean that we won't be able to then switch over to a slightly different strategy. So if we start looking at executive fully furnished rentals, you arguably should have the place already set up. You should be able to transition quite smoothly, arguably, into executive fully furnished rental and that market. And you're still not going to make the type of margins you would using Airbnb, but you should be able to turn your property. One of the problems that we're having right now with all of our clients is that they are buying, most properties out there, especially if you just have like a condo or something like that, it's cash flow negative out of the gate. A condo, 20% down in downtown core, is going to be cash flow negative, roughly $400 or so. One way that we can start looking at those as viable investment properties is by exploring this new rental strategy, which is like an executive fully furnished rental strategy, to bolster our acquisition strategy. And so, if we can overcome that $400 to $500 negative cash flow by, when you go to purchase your property, you have your down payment, you have your closing costs, and then on top of that, maybe we're exploring this strategy right now, but maybe it makes sense to put aside another 10, 15, 20K, however much it costs. Consider that part of the capital injection or the capital outlay from the get-go. Fully furnish the place, and then go straight into the executive fully furnished rental market. And with that, you should easily be able to overcome the negative cash flow. So we're actually in the process of looking for an expert to speak about that strategy, possibly an executive rental firm, to come in and speak next month in April about that at the meetup. Actually, Jason, who do you use?
I brought in two companies, maybe even three, but two companies I talked to a lot about executive rental, and they were both, I think the technical term is useless. They brought through, I don't know, I just, it's two, so it's a small subset. Like I had two of them come through with families to look at the property, and then, it was $2,300 for 1,000 square foot place, and they asked why wasn't it the whole house? It's like,
Okay.
because we're not in Albuquerque. Then I swapped over and I used a company to fully manage it as an Airbnb. They trying to think of their name now. It'll come to me. I wasn't terribly happy with them. They managed it. It was very little work. They took a percentage. They set a base. We set a base amount. We said that we need to make this just to cover our costs, and then everything else was covered by. They then took a percentage, 20% of profits after that. But I didn't feel that they were always on the up and up with everything. Like, one of the big things if you do an Airbnb, if you get somebody else to run it, is make sure you use your own account. That's where I had a problem with them, is I gave them my account. We were trying to get it up that weekend, and they told me at the time, well, to get everything up quickly, we can use our account and move it over years later. And later on, they couldn't figure out how to do that, which was bullshit. And the idea was we were tied to them because we had created this multiple reservations over months, and we had a track record with Airbnb. So if we swapped to our account, we would lose all of that. So that would be a big piece of advice. If you do Airbnb, set up your own account and then hand that to the company and have them run it.
So you weren't using necessarily an executive rental firm, though. It was a firm that you contracted so that they would go manage your Airbnb.
In the end, yeah. I did contact 2 firms that just did executive rentals, and they brought, over the course of about 6 weeks, maybe 2 months, they brought a number of people, like 3 or 4 people through, and we discussed probably another 3 or 4 people, but nothing ever, they weren't able to get anybody.
Okay, so nothing materialized.
They wanted like my one unit's renting for $2,600, and they wanted to rent it furnished for like $2,850 or something. I'm like,
okay, so that didn't make any sense.
Just not worth it. It's got to that would have to be like $3,500 to get an ROI in 24 months.
Cover their costs and everything.
Yeah.
We're in the process of trying to find that firm and trying to establish those relationships. I know that Florence had worked with one that where it did make a lot of sense.
Great.
She had in Little Italy. She purchased a triplex. She did a renovation. She lived in one. I'm talking about her. She's not even here, but she lived in one unit. So she spent a little bit more money in that unit when she was going through the reno. So a little bit more money because she was living there, so she wanted to be a bit nicer. And then she left. She went back. She wanted to move back to King West. So she moved back to King West, and she rented out her place. And again, location was key here. I think she ended up getting she hired an executive rental firm. This is the one that we're kind of reaching out to have a chat right now. I think she got a doctor in there because she's very, very close to Toronto Western Hospital. So she got a doctor in there, a physician or a surgeon or something. And I think, we estimate her market rent to be about, $2,600. And I think they got someone in there for like $3,400 or something like that. So it can make sense based on the unit, based on location. So we're exploring that as a strategy right now. Not necessarily the short-term rental. It's going to be the longer-term stuff, and hopefully that means at least 6 months or even better, a year. So anyway, that's something that we're going to talk about next month. Yeah.
Definitely. Sorry, this is Carl.
Hi, Carl.
Hi. Yeah, I had a exclusive luxury rental for over 8 years next to the waterfront, also very close to a GO train station, a duplex. I've had people who were retired U.S. military to people who work as physicists and collecting rent.
Sorry, Carl, we can barely hear you.
Oh, okay. How's that? Is that better?
I don't know. I could see John being like,
Is that better?
Slightly. No, John's saying no.
Okay. Well, so maybe I got you on Bluetooth, so maybe that's why. One second. How about that?
Yeah, there we go. Now we can hear you.
Oh, okay, perfect. Yeah, I have a luxury condo an exclusive neighborhood. But it was like 3 minutes from the GO station.
You said it was along the waterfront, right? Whereabouts?
Correct. East Toronto, like Ajax.
Ajax, okay.
Yeah. And basically, it's a duplex. And I had a designer come in and, of course, do the finishing touches. I've had from U.S. military to physicists rent for me over a 6-7 year period. Rents anywhere between, say, $2,800 to $3,200 a month.
What would regular rental rates be
for the area, for the neighborhood?
Yeah. So if you weren't employing this strategy,
the regular rents were around $2,000, $2,200.
Okay, so you're getting a good 25% margin, something like that.
Correct.
30% margin.
And I found basically I guess you could say strategy I used for, renting a luxury condo was, well, put yourself in a position where you're going to go buy a Ferrari. What would Ferrari ask you for? So I basically showed my Ferrari, and I'd ask exactly what Ferrari would ask for. And you find just from the look and the cost of that Ferrari, you get to, you navigate through the people who understand what they're getting, who want what you've got, and rents aren't so much an issue. Let's face it, if you're in the market for a Ferrari, you've got the money for a Ferrari.
Yeah. And,
and I would...
Sorry, go ahead.
No, I was going to say, and, I have a financial background, so basically I would use that, as my basis to what I want to see from the potential renter. Credits, the beacon scores, you name it. So, I'm not going to let Ferrari go for $10.
Yeah. Did you, sorry, maybe I missed this. Did you do this yourself completely? Like, I know that you hired a designer, but did you have an executive rental firm, or you managed to make this work on your own?
No, I did this on my own. I did some research through, what's that real estate company? Colliers.
Yeah.
To find out, what avenues they took to find, potential buyers, renters to lease, or so on and so forth. And I found 2 or 3 avenues that they previously used. I don't believe they use them anymore. But I took the very same avenues, and the clientele was night and day. The people who were making a good income, high 5, low 6-figure incomes, were, good. I was getting their attention. Then I found the people who are just in the upper echelon, who were, probably making close to $500,000 a year, and they were looking either for themselves or for their kids or a relative, what have you. But either they rented from me or they had a relative who wanted to rent from me, and they would back it up.
Yeah,
and as long as they brought the right information to me and it made sense, all right, sign here and you deposit and see you later.
Yeah, no, for sure.
Can you talk about the strategy of how you found those people?
Like I said, I called up Colliers just to find out, how they find theirs. I mean, if you look at Colliers, when they do real estate, they do residential, they do commercial, but also they have a specialty area where you can find people who want to buy, a lake, a pond, acreage, so on and so forth. So I just looked in to see, okay, where they went. I called up Colliers to find out from one of their agents, how can I see those type of listings, and they gave me that avenue.
But
so I went that avenue.
Specifically, how did you find these people? Like, did you list it somewhere? Did you use Kijiji? Did you use Craigslist? Or is there some sort of listing service that caters to this? Well, basically,
how can I put this? I just basically monkey wrenched from their, I guess you could say, MO, and use the same type of, advertising they would use to find those renters. Like, let's say, give you an example. Let's say there's an exclusive property next to High Park or next to Rosedale. Then you found people who were looking for Rosedale or Rosedale Light.
So how were you finding those people?
No, they would find me because I would put keywords in to get their attention.
So, but where were you listing it? Like, did you have a website with Google Ads? Like, what was your marketing like?
Actually, I was using Craigslist because I found Kijiji. Yeah, because I found Kijiji sounds not to sound snobbish, but the everyday person who couldn't afford that.
Yeah, no, that makes sense. Like I have that exact same experience here in the annex. When my wife and I moved to Sweden for a year, I rented my place myself using
Right.
Craigslist, I think it was, and someone came in. It was the exact profile I was looking for. I got the premium rents. My furniture was already set up. I'm working out of my home today, but furniture was already set up. My wife and I, made the place nice because we live here.
Right.
Yeah, it works for sure.
It definitely does. Actually,
Yeah.
I've got a question on if anybody knows about eviction. I'm going through my first eviction right now. I've never done it before, but I've got a property which I'm renting out, and the the hearing is in 2 days.
Yeah.
And the person, I guess, is panicking like crazy, and they're throwing rents at me now, finally, after, partial rent anyways. They throw something at me 2 days beforehand. Now, if anybody knows, does that operate the same as if they were just paying late? And if I accept it, does the whole process start over again, or does it, or is it too late for that person to do anything at this point?
My understanding is that's one of the strategies, is that you hold the full thing out and then you drop some money down at the last minute and it restarts the clock on it.
Yeah.
Right.
So actually, you need to be perfectly honest. This is
Okay.
if they're going through this and they're playing these games, then you are going to be better off speaking to a professional paralegal and getting them on your side, and making sure, because like Jason said, that's one of the, this is what professional tenants do. They know how to game the system. They know how to stay hearings. They know how to give you a little bit of money. It resets the clock and all that stuff. It's fortunately, it's not something a lot of our clients who invest in Toronto have gone through. However, when I invested out in smaller towns, it was much more common, and I wouldn't even get involved. I handed the whole thing off to a paralegal because I just said, I can't deal with this. We don't get this a lot in Toronto because of our tenant profile, which is part of why the business model works, and it works smoothly. But in some of these smaller towns like the Hamiltons and everything else, it is much more common. I have a paralegal practically under retainer out there, and basically I'm going through an eviction right now, and they're doing almost the exact same thing. I don't want to know about it. I don't care. I have a team who's going to take care of that for me.
Can I add two things to that? One, I think if we go back 8 years, there's professional tenants that know all the ins and outs. Nowadays, you go on Facebook and you say, oh, my landlord is being mean to me. He actually wants me to pay my rent this month. And they will get the whole list of FAQ on how to screw over the landlord, in 5 minutes. So it's not even professional people now. It's just any millennial who feels that they deserve not to pay this month.
Yeah, and we're seeing that a lot with these newspaper articles, right? Newspaper articles, and they're talking about I've seen a whole bunch of them. There's a one on College Street here, where the person who came in basically tried to evict everyone, and then getting way more in rent. And then obviously the newspaper article was taking the side of the tenants and saying, oh, even with the penalty that I have to pay, 1 year of the increased, 6 months of the increased rent pays out the penalty, the fees that they had to compensate the tenants.
That was that $75,000 thing they got, right?
Yeah.
Where they assumed that all the rent money just went straight into the person's pocket. That they didn't have any
I know.
costs.
It's such a myopic view. But anyway, Jason's point is well taken. This is becoming more and more of an issue.
That's why you do massive work ahead of time and don't get bad renters in the first place.
Yeah, that's
where to put the effort.
And you buy in good areas. We tout Toronto because we've been through the trenches. The Volition team has bought out in places like Hamilton and Kitchener-Waterloo and Sudbury and Edmonton. We know what's out there, and which is part of why we bring it back to Toronto, and why we focus on one particular tenant profile. We select our tenant profile, and then we build our business model around them. We don't just select a property and see who we get. That's leaving it to chance. right? So I'm going to move on. There's a couple other questions in here. Let's see. John Borello. Johnny, does anyone have an experience selling a condo as an assignment? Yes. Actually, we are literally doing that right now. What's your question?
Just all the legalities involved in it. Is there a good return on investment? I don't know much about it. I've heard of it.
What's your situation?
I'm thinking of a condo here in the downtown, but I can get the deposit, but then at the end, I don't know if I'll be able to get the mortgage for the rest of it. So I'm thinking of, because it hasn't been built, but it'll be built and then it'll be ready in about 2-3 years. But then by that time, hopefully the value will have increased, and so I can make a better return on the initial deposit. So I don't know if anybody has any experience with it.
Sorry, so just to clarify, do you currently own a pre-construction condo?
No, I'm looking at it.
You're looking at buying the pre-construction condo?
Yeah.
Okay. Or buying an assignment?
Yeah.
Okay.
Yeah.
Okay, because your question was, do you have any experience selling the condo as assignment? So that's why I wasn't sure if you already had the condo.
No. Just I'm thinking 2-3 years down the line, if something comes up, then they could turn around.
Okay, yeah, sure. Let's talk about that. So currently we have a client who's approached us, and this exact same situation. I'll give you a very, very specific example, actually. Okay. So he purchased at Queen and Spadina. It was a Tridel build. It's called SQ2, and he purchased it 4 or 5 years ago for $360. It was a 1+1, 570 square feet, something like that. So he bought it at like 600 square foot or something like that, right? Now, a number of years later, he's coming up on close, and he's like, you know what? It's going to be a pain in the ass for me to come up with all of the money to close, right? He didn't structure it. He was going to have to pay HST upon close because he wasn't owner occupied, or he didn't say he was owner occupied. So you'd have to come up with the additional HST upon close, obviously the rest of the down payment, closing costs, and on top of that, the development fees, educational levies, and hydro hookup fees. Substantial amount of cash. He's like, you know what? I made a bunch of money on this condo. I know that if I closed on it, got a mortgage and whatever, I could probably make more.
Right.
Comps in the neighborhood, or whatever, call it 1,100 a square foot, right? And he's like, yeah, I'm happy to let it go for 1,000 a square foot, because it's no hassle, no fuss. I could just assign this thing, be done, walk away with my profit. So he wanted to sell it for like 540, right? If he closed on it, he would make more, but more hassle. So it's the amount of work versus reward. So he's like, you know what? I just want to assign it. So this is a great opportunity for like so many different parties. It's great for him. He can walk away with 360 to 540. That's a good $180,000 profit. Obviously, he has costs and stuff, but a substantial amount of profit for just basically signing a few pieces of paper, a few checks 5 years ago, right? So he's happy. Is he maximizing? Is he didn't want to, because he didn't want to go through the work. He didn't want to qualify for a mortgage and all that other stuff. Fine. Now for our buyer who's coming in, so we have an investor. I just told you, most places in downtown Toronto, or most condos that you buy resale right now, is going to be cash flow negative, $400, let's say. So this person comes in and goes, hey, you know what? At the price that he's willing to let it go for, I can actually cash flow neutral. They're happy, right? So it's a win for the buyer and a win for the seller. The seller walks away, no fuss, no hassle, walks away with a substantial profit. The buyer comes in and is able to get cash flow neutral when everything else that they would buy would be cash flow negative. So it is a very viable strategy. We're helping our clients do this right now. In fact, and I mentioned this at the last meetup for those who were there, we actually see 2019 as the year of the assignments. And this is why. There's typically there's about 15,000 units that come online in Toronto every year. They're projecting 25,000 to come online this year. Basically, it's just a matter of when these were all sold, pre-construction, right? They were sold a number of years ago, and now they're all approaching, the final stages, occupancy, and a whole bunch of these people, they bought it prior to Bill B20 coming out, so their mortgage qualification has dropped 22 to 23%. Can't qualify for a mortgage. Don't want to qualify for a mortgage. Don't have the cash, or don't have all the rest of the down payment, closing costs, and everything else. Or it was their strategy right from the get-go just to assign it. So there's going to be a whole glut of people who are going to come on, whose units are going to come online that they're going to want to assign. They're happy. They're going to be happy because their units have gone up in value, and our investors are coming and looking very, very heavily at these assignments now. So we actually think Volition is well positioned to be able to kind of create this marketplace. It's a bit different than most assignments. And be careful about this, John, if and when you go down this path. When you go sign a pre-construction contract, they don't let you list it on MLS to assign, right? It's because the developer holds back some units and sells them, so they don't want to conflict of interest and all that stuff. So they don't allow you to list. So if you can't list, how the hell do you sell it? You have to work with someone who has an extremely strong network, and that's one of the positive aspects, or one of the benefits that we think. So we think Volition is well positioned to be able to create this marketplace for assignments, because we have clients who are looking to sell their assignments for the various reasons I just mentioned, and we have a bunch of buyers who are looking for deals or better cash flow or what have you. So we actually think that we're going to do a lot of Volition thinks that we're going to be able to create a marketplace for assignments this year, and we're going to be doing a lot of assignments this year, we think.
Yeah, Matt, I just want to chime in on that. I agree with you. There's a lot of upside to buying on assignment. And I guess, John, to your question, what are the risks? I do have fellow investors that are actually taking advantage of people who buy on assignment that are unable to close because Matt said because of the mortgage qualification. So I guess, Matt's obviously explained all the upsides. So just keeping in mind on the downside, if you do plan to close, you're going to have to be wary or careful if you are able to close. If not, then people like my investor friends, they're going to be taking advantage of people who can't close, lowballing you, and maybe not giving you full value for what you expect to sell the property at because of all the supply that's coming online. So I guess you probably just want to keep an eye on that, and factor that into your decision making on whether you're able to close and things like that.
Yeah. And obviously there are risks. Like if you're employing assignments as a strategy, you are depending on growth, appreciation. I mean, like if you're looking at assigning, you have to cover all of your costs at the very least, right? So if you're banking on that is a risk. You have to know, you have to be okay with that risk. And if you're not okay with that risk, then what's your plan B? Is your plan B to close on the unit, to rent it out? Then you have to start looking at what would the market rents be at that point in time? Can you cash flow? Thanks, Jamie. It's obviously, there's no perfect investment strategy. It's all about the pros and cons, for sure. Anything else you want to add, Jamie?
No, I think we've covered the pros and cons. I don't really have anything else.
And the other thing is for assignments, just as another point, for assignments, if you're assigning, you're not always off scot-free. If the person who buys your assignment from you, in theory, that person is now on the hook. But if that person can't close, that developer might still come after you, even though you have this, assignment agreement with them.
Well, and Matt, just one other thing that you mentioned at the REIN meeting when you were on stage on the panel a couple of months ago when we were talking about pre-construction. One thing you mentioned is when you go into buying a pre-construction is make sure the property is assignable. And I think you had elaborated on that and just making sure, looking at the contract and everything in the details, reading all the fine print and just making sure your bases are covered. I don't know too much about it, but Matt definitely elaborated on that at the last REIN meeting there. So another thing to keep in mind.
Thanks, Jamie. I completely forgot about that. I spoke at a REIN meeting. I was on a panel a few months ago, and I think I actually recorded the entire meeting. So if you're interested, just ping me, and I'll see if I can fish up that recording, and I can share that with you, or maybe I'll post it on our website or something. I completely forgot. I tape all this stuff. I have all this content, but I never share it with anyone.
Well, Matt, everything you say, I just remember, so it's all in here for me.
It's all in here. A couple other things. So make sure that you, if you're buying a pre-construction, make sure you have a lawyer. This is all like very, very basic stuff, but have a lawyer review your contract. Make sure you cap the development fees so you don't get screwed at the very end. Make sure you have an assignment clause in there. It varies per developer, but it could be $5,000 most times, something like that. Okay, cool. Have we exhausted assignments? You cool, John? Okay.
You might want to add I think CRA made changes this past year around assignments. I think they're now they get reported now versus used.
Yeah, they're starting. Yeah, they're starting to. So CRA, HST is a whole other ball game that we could get into. I'm not an expert. I'm familiar with a few aspects. I'm not an expert. However, what Jason's talking about, basically, the CRA wants to dabble in assignments because they see it as a profit center for them. A lot of people, basically, the idea is, okay, so we all know what capital gains is, right? You buy it here, you sell it here, and this is your capital gain. If it's your primary residence, capital gains exempt, right? The CRA does not think that assignments it falls under capital gains. They think it is the active business income. And especially if you've done it once, you've done it twice, you've done it 3 times, and you've done it 10 times, right? So I think Adam was on this call. So, I mean, if you're doing this as a business, like Adam was, then, you have all this profit, but that profit may be taxed at active business income, not capital gains, maybe. So again, this takes some forethought and some foresight. If you're doing this, does it make sense to do this within a corporation? In a corporation, active business income is taxed at 15%, roughly, not at your marginal tax rate. So there's a whole lot here that we could talk about. But is that good enough for you for now?
Yeah, that's a lot.
Okay. Cool. All right. Who's next? So SK is asking, can we talk about HELOC as a method of funding an investment property, whether as a down payment or mortgage replacement? Why or why not? Risky. So SK. So who is SK? I see her or him.
Hey, Matt.
Hey.
We actually chatted yesterday. It's Sean.
Oh, it's Sean. Hey, Sean. How are you doing?
Good.
Cool. Yeah. So do you want to elaborate on your question before we get into it?
Yeah, I mean, I just see people kind of talking about how they increase their portfolio, the real estate portfolio, and have always wondered how people are able to pick up, 2 or 3 extra properties a year or maybe more, especially when they're starting out. Like, how are they getting all that capital to fund it? And I know that HELOC is often a term that's thrown around. To me, it sounds like it's just like a whole other mortgage, but I mean, I've read up a little bit on it and know that there are a few differences, but wondering like how often is that used? Is that something that should be discouraged? Is it a good method to kind of fund another, either a down payment or a mortgage on a second or third or fourth property, in that you don't have to repay the principal right away? So yeah. Yep.
It's a short answer is it's a great strategy. Without getting into it, I literally have delivered an entire meetup presentation around how to grow your portfolio. I'll we can go over that in more detail. However, very, very broadly speaking, here, I'll see if I can draw this with my hand. Oh, you know what? So I have my iPad here. Let me see if I can draw this. There's a whiteboard feature, which I think is pretty cool. Can everyone see this?
Yep.
Okay, let's see if technology these days, huh? Can you see my drawing? Okay, can everyone see it?
Yeah.
Yeah. Okay, so this is basically, let's say that you buy a property and let's say it goes up in value, right? And then you have a mortgage, it goes down in value. So this was your initial down payment, and then over time it grows. Call this down payment at this point. Normally it's 20%, right? So let's just say on $1 million property it was 200K. And let's say this $1 million property goes up to, let's say, 1.3 million eventually. So your $1.3 million property, sorry, what's 80% of 1.3?
80%.
Was it
1.04.
There we go, thanks. So let's say that your new mortgage is 1.04, right? So your old mortgage was 800K because you had a 200K down payment. And then your new okay, so let me back up. The property value is 1 million. It's gone up to 1.3. Your original mortgage was 800K. So $1 million property, original mortgage is 200K, 800K. The property value goes up to 1.3 million. And the mortgage over a number of years, let's say it went down to, you paid off a little bit of the mortgage. Let's say it's 780. If I refinance this property at 1.3, this is the new mortgage I can take out. Whether it's a HELOC or not, that's just the financing question. It can be a HELOC or you just refinance the entire value of the property. But what you do is you refinance this old mortgage, which is 780, and now that difference is, I need someone to do my math for me.
220, 224.
Okay, let's just, okay, whatever it is, it's a substantial sum. That's the equity takeout that you use in order to accelerate your growth. Go buy another one. That's sort of the strategy in a nutshell. Does that make sense, Sean?
Kind of. That's different than what I've read, but I'm still processing it.
Sure.
So are there risks involved in this, or like what are the risks involved in this?
Yeah, I mean, at the end of the day, you're more leveraged, right? At the end of the day, you have, if you're more leveraged, you're more exposed to ups and downs of the market. So that's where it becomes very, very important to know the market that you're investing in, to understand what the long-term potential of that market is and what the risks are, right, of that market. So a number of people on this call, myself included, and Jason and Danius and a bunch of people on this call and have all employed this very same strategy. It's basically to use the equity growth in your property due to forced appreciation because of renovations, market appreciation or growth, and mortgage paydown, which is a tiny bit. The combination of those three things is going to create more equity in your property, and that's what you use. You do an equity takeout and you use that to roll forward.
I'm back. Thank you, Matt. I can hear you.
Oh, okay. It only took 50 minutes.
That's right.
Is that cool, Sean? I don't want to get into too much because we've talked about this a lot before. So I'm happy to to send you some materials on that if you need it.
Yeah, I think we're good for now. If you've got other sources that I can take a look at for sure. Thanks so much.
No problem. Nicole K. She's still here? She is not here. Okay. What did she ask? Interested in HELOC as well as flipping to yourself. Does anyone have insights on those strategies? Hey, Jason, you want to talk about yours? No? Oh, you're on mute. You're on mute. Jason,
what would you like me to, can you repeat that?
Yeah, I mean, I just feel like I feel like I'm boring everyone because I'm talking so much. Basically, she's saying interested in HELOC as well as flipping to yourself. Flipping to yourself is basically the BRRRR model.
What, like speak about my experience using HELOCs?
Or just kind of like this concept of flipping to yourself. Flipping to yourself is really just like after you do the renovation, instead of selling to someone else, you're selling to yourself. So
I don't know that term. Like what? That you're like I did my renovation and increased the value of the property.
Yeah.
I haven't finished or started the refinance stuff with Vine yet,
yeah.
but
that once you did the refi, that would
Yeah.
be the completion of the BRRRR model,
Oh,
which would be
yeah.
Flipping to yourself.
Oh,
So
okay, you're considering that the flip. Okay.
Yeah. So there's a couple of different terms to it. Flipping to yourself is one term. Long flip is another one. Some people say short flip is like, right, sell to someone else. Long flip is basically keeping the property. These are all different names for the same thing. Like there aren't a lot of different strategies. People just give new names. They try to sell you some course or something like that. At the end of the day, there's not a lot of variance in this. There's a few basic fundamentals you need to learn, and this is what we teach. But there's not a lot of variation. So I don't know. Do you want to talk about your property, or I could talk about another property?
I can talk about it. I'm just not sure what aspects. Like I can give my thoughts on why I've used HELOC to purchase 3 properties.
I mean, you could talk about that. I was going to say more about the flipping to your, like your experience of the BRRRR model, the buy, reno, rent, refi.
On a high level, I purchased a property for 1.4.
Where was it?
It was 1.4 initial.
Where?
Purchase price in Roncesvalles.
Yeah. How many units?
4 unit. Yeah, I'll say 4 units. There's a whole story around that. And then put about $330,000 into the renovation on it. And so it's assumed that we're hoping it's going to be somewhere around hopefully 1.9 to 2.1 kind of cost or value when it's finally refinanced this year.
Yeah. So what would as is when you purchased it? What was the rent potential of it, and what's the rent potential of it now? I think he's being displaced. Okay, here while he's doing that.
Sorry, I was getting displaced there. The original numbers on rent, you're trying to you're doing your Craigslist research, seem to be around the 1,400 kind of mark, 13
per unit.
Sorry, the basement I think was that, and then they went up to sort of 1,900 to 2,000. In the end, yeah, per unit.
Yeah.
In the end, I was renting them for $2,150, $2,650, and then I've got one that's renting as a executive rental for $3,000.
Yeah. So I think when Jason and I were talking about the end result, and I know we're not even at the end result yet because we still have to, base the additional unit in the basement and refinance at the end. But I'll give you a quick rundown on those numbers again, so because Jason left. Okay, so acquisition of 1.4, right? You put in, I think you said what, 320, like three something, 350 something.
Yeah.
In renos.
Yeah.
Sorry, did you say 320 or 350?
It was. I'm going to say 350 is probably with all the added sort of minor costs.
Yeah, about 350, and so basically those rents as is were under market, or not that they were under market, is that the capital hadn't been put to highest and best use yet. The property had not been put to highest and best use yet. Location wise, it was in Roncesvalles. It was really close. So Roncy is a total up and coming neighborhood, if not already up and came neighborhood. It's transformed completely. It's a neighborhood that we love. And Jason's property was actually really close to St. Joseph's Hospital as well. Right, so we're looking at a bunch of these things. Roncy also has a dedicated streetcar track that will bring you into downtown, like tons of stuff like that. Right near High Park, lots of stuff. So we saw lots of potential in this property. 4 units, needed substantial work, and went in and did that work. Took a year or something like that, right?
It took a year and 4 of my life, yeah.
You know, obviously a lot of pain. Renovations are not easy. It can suck the life out of you. But you know, if you're willing to put in the time and effort and keep your eye on the ball, but here are the results. You know, at the very end, you have rents. I think I wasn't calculating, but I think once we get that basement unit, we're into like what, 8,500 in rent. Just call it regular rental rates.
We're currently we're cash flowing right now about $1,000 a month, and I don't have the 4th unit in.
Yeah, so there's still tons of upside potential. I think if I remember correctly, your number's like 8,500 to 9,000, even if you're taking take away the executive rental and just regular rental rates. And that upside potential, roughly speaking, we say for every dollar you put into renovation, you usually get $1.50 of value out. Jason put a lot of sweat equity in as well. I think he got his hands dirty with the demo and everything else. But yeah, you know, I think from the sounds of it, I think those numbers, your target is actually going to be even higher than the $1.50 of value out for every dollar renovation in. So, you know, 1.4, 350 in renos. So you enter like the 1.75 range. But valuation wise, I think that valuation, like I know that area. I also know based on the rents that Jason's getting, his valuation should come in over the 2 million mark. 2 to 2.1, I would be fairly confident in saying. So there's that upside potential, which far exceeds even what we project for the $1 and $1.50 of value out. So and even after Jason refis at the end, he's going to have arguably a cash flow positive property. Or if it's not, then you can still play with those numbers. You don't have to pull everything out. Maybe you pull some of it out, or structure like a HELOC and pull it out as you need it and stuff like that. But very strong strategy. And it's this is sort of like flipping to yourself is just another term for it. The term that we've used in the past too is called BRRR. B-R-R-R. R. Buy, reno, rent, refi, repeat. Or rinse, repeat. So the BRRRR model is a very strong model. Our clients take advantage of quite often. I'll throw out some more anecdotes. We have another client. She purchased a triplex for 1.2. And she put 2 in renos, 200 or so. So total cost 1.4, and I think she just got it appraised. Literally, I got appraised yesterday for 1.6, and that's been about a year and a half. So you know, these numbers aren't fictitious; these are real life numbers. And so she's going to refi, pull out a whole crap load of equity. She's going to go buy another property. Cool. Any other questions?
I wonder does that answer that question?
I don't know. Yeah.
Well, like, the way I look at HELOCs, it's just you go to buy a property and they say, you know, you're going to need, if you're in Toronto, you're going to need a couple $100,000. So you look in your bank account and you either have, well, you shouldn't have cash floating around that means anything. The way I think it should be investing somewhere. So you either have that in, you know, in ETFs or mutual funds, or you have it sitting on a mortgage, keeping it low until you buy another property. And so that's what I do. I usually, huge chunk of the money that I use to purchase a property is coming out of my other properties. Yeah. Is what I did in the past.
Yeah, a very common strategy, and really it's one of the few strategies people use in order to keep on building their portfolio. Like let's face it, like Jason's exactly right. Who's gonna have $200,000, $300,000, $400,000, $500,000, $600,000 sitting in their bank account? Like how many lifetimes would you need to work to earn that and have that sit in your bank account, right? Not everyone, like unless you're born with a silver spoon, and you know, I wasn't, I don't think a lot of people are. How else do you generate wealth? And I mean, I have a slightly different view than some people. Some people are like, oh, you know, save and make sure you know, invest in ETFs and stuff like that. And like, okay, yeah, for sure, that works for some people. The view that we take is that we build wealth through smart investments, right? And we also build wealth. The other thing to realize is that when you're real estate investing is the wrong term. Investing is completely the wrong term. You're buying a business and you're running a business now, right? So don't think that this is just some passive thing. If you want to be a passive investor, yeah, go buy some stocks, go buy some ETFs, or you need a partner with a real estate expert who will handle everything for you, who will run that business for you. And that's what an asset manager is.
May I ask Jason a question?
Sure.
Jason, it's Maureen, and I would like to know if you formed a corporation in order to buy dual properties. Maybe you have even more, I'm not sure.
I didn't. My accountant owns multiple properties, and every year I ask him about it, and every year he says, with the level of complexity that I have, it's not worth it. And I ask him about the long term, because my plan is to have sort of upwards of 10 properties. He doesn't think it's worth the extra cost and complexity around it. This is a, how do I
secure yourself from issues?
Insurance. I've got, I do insurance with a company that came in with the meetup group at one point, that they deal with investors. And so I just have a, you know, somebody trips and falls down the stairs. So I've got a, I want to say $10 million or something. And so that's how I'm going to get out of it. If they get sued, we'll go through that.
Have you made them sort of isolated from each other or not?
No. No, they're all under my name. So if somebody sued me and then could eat through my insurance coverage, I would be in trouble at that point.
Yeah.
All right, I just wondered how that worked. Thank you.
So Maureen, we have an accountant coming in next month. I think you were off the line when I mentioned this.
Yeah, I missed most of today.
Yeah. So sorry, I keep on saying next month. It's March 20th. So come to that. You'll be able to ask the questions directly to an accountant who will be able to. He's a real estate investor focused accountant as well. So he'll be able to help you out there. One caveat, I do want to say this. George and Peter are very pro corporation, actually, and it still, like, even if you ask this, even if you ask two real estate focused accountants, they can still give you two different answers, right? So I will preface this by saying they are very pro corporation. They put me into these corporations as well. My structure, I think I have like 4 corporations, and it's like, it's a pain in the ass. I'll just tell you that right now. The costs involved, the complexity, the bookkeeping, the tax returns, like it costs me over $2,000 per corporation to file tax returns, right? You've got, and then I have to pay my lawyer $300 every year for my annual resolution of minutes or some crap. I'm like, what is this? I don't even know what this is. Why am I paying? So got to do it though. So, and then I have to pay my bookkeeper more because she's managing yet another set of books. And I have a separate bank account, and I've got all this tracking to do. Is it worth it? There's no right answer. There's no one size.
It would be worth it if you had a problem only.
Well, define a problem, right? So as you know, you're talking about, you know, liability. Okay.
Yeah.
So I'll tell you the reality of how a lot of this works. in theory, these are supposed to be insulated and siloed type of structures, right? Meaning that, and my lawyer also is very pro corporation, but my mortgage broker isn't, right? Because they know that the reality is, if you're trying to buy in a corporation, you're either going to go to commercial financing, or you're going to pay or you're going to pay an excess rates, and you have to pay lender fees, and you have to pay commercial appraisal fees, and enter your structural report and environmental phase 1, possibly environmental phase 2. And they also know that it takes 60 days to get commercial financing approval. So like, they're like, why would you do that for, if it's not a commercial entity that you're actually buying? So, but an accountant has a different view, and a lawyer has a different view, and a mortgage broker has a different view, right? So my lawyer says, don't put more than $2 million of assets into a corporation. That way they're insulated from each other, right? Great, yes, in theory. And in Toronto, that's like one asset. So, well, I'm gonna have like 15, 20 corporations. It's ridiculous, right? I'd have to hire a whole new team just to manage my financials. Anyway, he says, don't put more than $2 million of assets into any one corporation, right? The reality, and he says, because, you know, if you have, he's like, ideally you have one house per corporation, or one asset per corporation, so they're completely insulated. However, the reality is, if I go to actually get a mortgage, the corporation, how the corporation going to get a mortgage, right? The corporation is, so the lender is going to look at me in order to qualify, and I have to put a personal guarantee on the mortgage. That already pierces that veil of infallibility that you think you might have. So, you know, there's the theory, and then there's the reality. And I'm not saying corporations are bad. I have a whole bunch. I have them for very specific reasons, you know, long-term estate planning reasons and stuff like that. And so I'm paying the short-term pain. I have short-term pain now, but I have a longer-term plan in place. That's why arguably it makes sense. But if you don't understand those reasons, then there's very little reason for you to be buying in these corporations. It's a lot more complexity than it may be worth, unless you have a very good and explicit reason to do so. Cool?
Thank you.
Yeah, no problem. Was there anything else? There was a couple of questions. Oh, Maureen, you were asking about condos. We talked about condos a little bit when I think you're off the line. So this is being recorded, so you know, you can get a copy of it afterward, and so you can.
Yes, I will do that. So you don't have to repeat it for me. That's fine.
We were talking specifically about pre-construction and assignments. However, just to, you know, your question was just more general of whether condos in general. Condos have their place, right? Condos are often a stepping stone for people to get in. And then once they've built some equity in the condos, they can, like, condos can be a strategy unto themselves, or they can be the stepping stone to something bigger and better. So, you know, Jason was a prime example. You know, the 2 investment condos or primary residents that turned into investment condos that he had were the stepping stone to his 4-plex in Roncy, right? So condos. If, you know, why not? It's a much larger conversation, but there definitely is a place for it. There are pros and cons. You just need to be aware of that and see how that fits into your overall investment strategy.
Well,
Sorry.
I like the thought that Jason used them as a basis for going further, and
Yeah. Sorry, I hate giving general answers. It's just that we're kind of running a little short of time. We're actually over time, but I just want to, there's a couple other questions here. Should you include or exclude utilities in the rent? Pros and cons. There is no right answer. I include them if, okay, so generally speaking, I include them because I want to show higher rents. Showing higher rents usually helps with appraisals, valuation, helps with lenders when I go and I show my leases and stuff like that. So there's lots of reasons to do it, and then there's lots of reasons to not do it as well. Rising hydro rates, you know, my ability to raise rents at 1.8% or whatever usually it doesn't compensate enough for the increased use of hydro, for example, right? Hydro rates are going through the roof. So there's lots of reasons not to as well. If I have separate meters, I will usually put the hydro in the tenant's name though, because it's already set up for you for that. So I do that. But generally speaking, otherwise I have them in my name. That's a really short answer though. Does anyone have any comments? No? Cool. Okay, last question that came off the meetup site. I'm interested in hiring a property manager to not have to deal with the day-to-day workings with the property and tenants. However, I'm wondering, since property managers get paid the same regardless of the quality of their work, and as homeowners, often being away from the property and tenants, from your perspective, what are some measures that can be taken to continuously ensure your property manager is acting in your best interest without crossing boundaries with the PM or overstepping? To be honest, I don't understand the question. Does anyone else understand the question?
I think they just want to find a good property management company and don't know how.
Yeah, it's how to vet a property management company is what it sounds like.
Someone they trust. Someone they trust.
Yeah, I mean, this is less to do with a strategy or or anything like that, or like what should I do or how do I do this. I mean, if it's not someone that you think is acting in your best interests. Anyway, let's just back up. Okay, so number one, property managers are responsible for three things: placing your tenant, tenant relations, including rent collection, stuff like that, and coordinating repairs for maintaining your property. That's it, right? Property management is such a small facet of what we're doing in real estate investing. There's so many people. I talk to really novice investors, and they talk about how they're like, oh, I'll just buy that property. Yeah, it's a piece of shit, but it's a rundown, whatever. Yeah, it's not going to get the best tenants, whatever. The property manager's problem. I'll tell you right now, if it's your property manager's problem, it becomes your problem, right? And so don't ever fall into the trap that thinking, okay, someone else is going to deal with it. That's not the way to run your business, right? If you're not prepared, like if your property manager for whatever reason one day just falls off the map, are you prepared to step in, right? If the answer is no, don't buy that property. I'll tell you that right now. Which is part of the reason that people are like, oh yeah, I mean, we at Volition, we take a slightly different view. We're Toronto focused and Toronto centric, but we are for good reason. Like we've been through the trenches. Like I said, we've invested in all these other areas, and we've all brought our portfolios back to Toronto for these very reasons. It's like, of course you can get better cash flow in St. Catharines or Hamilton or some other buttfuck nowhere place, right? The reality is that investing in those places come with an inherent level of risk and or inherent level of headache, notwithstanding the fact that you're going to be driving out there often in order to deal with stuff, even if you have a property manager, right? Just imagine it's as simple as like, okay, my property value has gone up and I need to get reappraised, and because I want to refinance it. Who are you going to have open those doors, right? Yeah, you can have your property manager do it, but what the hell do they know? Like when we go to when we get an appraisal done, I'll tell you what we do. We pull all the comps, right? We put together a summary table of our property versus all the comparable properties. We put together a feature sheet. We package it all together. We meet the appraiser on site. We walk them through the property. We tell them everything about the property, everything we've upgraded, and why this property is comparable to all those other properties on the list. And then, we talk to them about, the tenants, the tenant profile, the rents we get. Who's going to be able to do that? That's an asset manager job. It's not a property manager job. So I guess what I'm saying is property management ends up being like, I don't know what the percentage is, 25, 30, 50. Whatever it is, it's a small percentage of the overall responsibilities of an asset manager or as a business person who's running a real estate investment business. So I don't know. I don't know if I answered this question. She's not even here. So, but anyway, we've already run over time. Is
Okay.
there any other questions you guys want to ask? This is for you guys. So
So
like,
the next meeting online is the 20th of March?
no, that's an in-person.
Oh,
meeting.
that's
So it's
right.
an in-person meetup.
Yeah.
March 20th.
Mhm.
It's at Hayden. Over on Hayden.
Yeah.
7 Hayden.
No. Oh,
No?
check the meetup. 2 days ago, we switched the location. It's
Oh.
at Bathurst and College now. It's
Hayden.
at a place called Peacock Pub, and actually I went and checked it out. It's super cool. Really nice. Really good beer, and really good food. So the guy who manages it, the general manager, used to be the general manager of the Queen and Beaver over at on Elm near Yonge Street. And I don't know if that means anything to you guys. I knew the Queen and Beaver. Their hand chopped burger was phenomenal, and that's the place that got me into Innocent Gun beer. I think it was one of the first places that had it. So I really like Queen and Beaver, which makes me think I'm really getting to like Peacock Pub. But anyway, we've had all these people were like, oh man, I really want food. I'm coming here after work and stuff. So we're like, okay, let's try to find somewhere that can accommodate that. So that's our next meetup.
Okay.
Yeah.
So Peacock Pub.
Yeah, check the meetup site for the details, but it's on College west of Bathurst.
Okay.
Yeah.
Perfect.
Okay. Anything else? Okay. The last thing. I'm gonna ask you informally right now, and I'm gonna put up this poll. This tool, this Zoom is pretty cool. So this poll is, let us know what you think. I need some feedback, basically. This is the first time we're doing it. Did you guys like it? Did you like the format? Do you find this helpful? Would you join again? Basically, there's two questions. How did you like it? How did you like this web chat format? And would you join again? Like, do you like doing this virtually online? Do you like this web chat? Do you like the time? Lunch hour. And I obviously it's informal right now. Like you guys can't add any additional comments, but let me know what you'd want to change about it. So we had maybe 20 some odd people join. So I'd like to see what you think. Like, I'm not going to do it if everyone's like, this is boring or this is shit or whatever. Like, I'm basically taking time out of my day to do this, right? So if it's not helping anyone, I'm not going to do it.
I thought it was helpful.
Cool.
I agree.
All right. Okay, cool. So I'm gonna end this poll. And then I'm gonna share the results. Can you see it?
Yeah.
Yeah.
All right. So we're anywhere from 7 to 10
I think that.
out of 10. And then a bunch of people would like me to continue running this. Okay, that's positive at least. And there's someone who said only if you made some changes. Okay, so if you want to make some changes, tell me what those changes need to be.
Yeah.
I'm not going to read your minds.
Yeah.
Okay, and if it's a matter of, hey, we spent too much time on one topic, or I didn't get a chance to ask my question, or I don't know, tell me. I mean, I'm trying to emulate the format of I sit down with people a lot, or I used to when I ran the advisory practice. I would sit down with people a lot. We would meet up, typically in a coffee shop. We'd have a coffee, Starbucks or something, and we'd sit there and like we'd chat, right? We would chat for an hour, hour and a half, 2 hours, whatever. And they would ask me questions. I'd get to know them. I would answer those questions. We would, I'm trying to just basically emulate that format in a kind of a more collaborative way. So that's why I call this a Coffeehouse chat. Yeah. So, but I'm open to feedback. I don't know if this is the best way to do it. Yeah. Anyway, so this is got some positive feedback, so that's promising. Anything else you guys want to add before we wrap up?
Just thank you.
Thanks for coming, Maureen, and thanks for being so diligent and rejoining after 50 minutes.
All right. Thanks a lot, Matt. Appreciate it.
Thanks, Jason, for your inputs and contributions.
See you on the 20th.
See you on the 20th.
All right. Take care, guys. Bye.
All right.